Securities firms like Santander and others operating on the island of Puerto Rico knew that investor risks were increasing dramatically but did not warn its own investors. On the other hand, firms like Santander sold its own Puerto Rican bonds out of its inventory to protect itself. After acting as underwriters, which often includes selling bonds to its own clients, Wall Street firms like Santander dumped the bonds from their unsold inventory into mutual funds they created, which were then marketed and sold exclusively to Puerto Rican investors. These mutual funds are not traded on any exchange and are not registered with the SEC, and more importantly, are exempt from many securities regulations. To make matters worse, securities firms like Santander peddled the bonds and the funds to its own customers and described the investment goals as preservation of capital. Puerto Rico is suffering from one of its worst recessions in its history. The Puerto Rican economy has been struggling with low growth, high unemployment, rising debt, and a host of other macroeconomic problems. Its poverty rate is double that of Mississippi, the poorest state in the Union. Puerto Rico's debt, however, estimated at $70 billion, represents a per capita burden of approximately $20,000 for every man and woman in Puerto Rico. As Puerto Rico plummeted into economic recession, its issuance of municipal debt skyrocketed. Global firms such as Santander, Popular, UBS, Citigroup, Goldman Sachs, and Merrill Lynch all made huge money on Puerto Rico's debt issuances. The Wall Street Journal estimated in 2013 that Puerto Rico had issued $61 billion in bonds since 2006, paying Wall Street firms like Santander and its lawyers $1.4 billion in fees. Santander and Popular and other securities firms helped the Puerto Rican government and the quasi-governmental entities issue increasingly risky debt deals and reaped hefty fees along the way. At the same time, these securities firms elicited demand for Puerto Rico's bonds by representing them as safe and secure investments and understating the true risks of holding Puerto Rican debt. When financial advisors of one bank raised concerns about selling risky Puerto Rican mutual funds concentrated in the Puerto Rican bonds to top management, they were told by the chairman of the board to sell them anyway, stating, "We are effed. The product, which is the only thing that is available right now, needs to be sold or go look for another job." These financial advisors put lipstick on the proverbial pig and followed orders, continuing to sell the ticking time bomb funds to its own clients. These securities firms knew it was a matter of when, not if, the Puerto Rican market would dramatically turn south. Numerous internal research reports and presentations from these securities firms indicated the broker-dealer were keenly aware of the substantial risks well before the decline. Puerto Rican attorney John Novatus and I are having an orientation for potential new clients at 6 o'clock on January 24th, Tuesday, at the San Juan Ritz-Carlton for investors with potential claims regarding Puerto Rican bonds. Almost 2,000 cases have already been filed. My firm, Levin, Papantonio, based out of Pensacola, Florida, is recognized as one of the most successful law firms on the mainland. We have over 40 attorneys, nearly 200 support staff, and have handled over 3,000 securities claims. When you hire a law firm, it is important to know it has the resources to go toe-to-toe with the largest companies in the world. If you suffered a significant loss from Puerto Rican investments in 2013, please attend our orientation and schedule an individualized appointment by calling the number below.